So continuing, from yesterday where we left off, which is basically looking at understanding, the frameworks of why financial, accounting is important, and what was the reason why this came about, some standards, framework, regulatory requirements, and obviously what kind of information does the statements that we end up producing, like income statement, cash flow statement, profit and loss, balance sheet, help us providing in terms of decision making. Now, today, in terms of the learning outcome that we're going to do is we're going to look at the practical aspect of it in terms of looking at preparing a cash flow statement. And then once we've prepared the cash flow statement, the idea would be to try and interpret what are the pieces of information that we get from there. And if you get lots of pieces of information from a financial perspective, which is somebody who's working in finance as an accountant, as a financial controller, somebody who's a CFO within the organization, depending on the size and scale of the operations, the idea would be to try and look at making some recommendations, which is what would be the key indicators that we get when we draw up a cash flow statement. So I'm going to try and show that with a bit of an example on an Excel spreadsheet. So we'll do that as we go along for one of the tasks. So I've created a bit of a sheet just to save a bit of time when we discuss this. And then we are looking at diving into some of the nitty-gritties of what information and how do we interpret that information which comes across from cash flow statements, specifically when we look at the annual journal reports and statements for some of the big organizations, and how do we interpret them, and obviously what is the usefulness of these statements. So the main part of the learning outcome that we're going to be focusing on today is to try and understand how to prepare one, and then when we prepared it, what are the key points that we get from that. How do we evaluate those points, make recommendations to the company or the business to see how they can improve their cash flows, what key indicators which are coming out, whether they're generating enough profit, whether they are not generating enough profit, what kind of activities they can look into, and then generally looking at how they're useful for the companies, from a point of view of looking at these statements overall. Now, I've got a video which is one of my favorite websites. I'm going to look at explaining, what are cash flows and cash flow statements. And we'll start off with that with a short video. Hopefully, they should kind of help us understand, get an overview of why these cash flow statements are, important. Let me start off and see if I can get this loaded.
Cash flow refers to the movement of cash into or out of an account, a business, or an investment. When cash inflows exceed outflows, this is generally considered to be a sign of good financial health, both for individuals and companies. Ed makes his living running Ed's carpets. For Ed, cash flow is essential to the survival of his business, as well as his personal finances. Having ample cash on hand ensures that Ed can pay his employees, his creditors, and himself on time, keeping the business afloat. The same goes for Ed. He needs enough cash in his personal bank account to pay for his house, his car, and other personal expenses. Whether we are talking about Ed or his business, there are generally three types of cash flows. 1. Operational cash flows refer to cash received or spent as a result of a company's business activities. For example, a business like Ed's Carpets brings in cash by selling carpets and sends cash out to pay employees and suppliers. Similarly, Ed pays himself a salary, providing cash flow to his personal account. Cash will flow out to pay for his expenses, such as food and housing. 2. Investment cash flows refer to cash received or spent through investing activities, basically the purchasing and selling of assets that will help grow the business, or in the case of Ed, assets that will help increase his net worth. 3. Financing cash flows refer to cash received through debt or paid out as debt repayments. For a company, issuing stock, paying down debt, and repurchasing shares would count as part of financing cash flows. For Ed, financing cash flows include any cash coming from loans or other types of debt, as well as payments going to pay down debts. If Ed's business comes up short on cash and is unable to pay its obligations, it will experience a cash flow crunch. To avoid insolvency, Ed will have to arrange some type of financing or bridge loan. A similar situation in Ed's personal accounts would also have disastrous effects that could lead to personal bankruptcy if the cash flow crunch persisted. For this reason, it is important that businesses and individuals manage their cash flow carefully and set aside emergency reserves to cushion any unexpected events.
So that gives us a bit of an idea in terms of why cash flows are quite important on the individual as well as on the business basis. So when we generally look at the situation of money coming in and money going out, that is normally going to be referred as, and then if we tabulate this into some sort of statements or, some sort of table to keep track of how the money is coming in and if it's coming in from regular activities and how the money is going out in terms of paying for some of those activities and expenses would help us basically generate what is called a cash flow statement. And I think this is something that we do on a daily basis when we look at setting up on the personal level direct debits. You look at what is money coming in, which is coming in from salaries, dividends, some sort of interest, consultancy fees, things like that. And then when we look at expenses going out, which would be typically, payments being made on personal side expenses for electricity, gas, rent, mortgage, HP or any other sort of things, would essentially be looking at, calculating money coming in, money going out. If that is put across as some sort of a tabulated statement, then, at some stage you would look at a frequency or you look at basically forecasting it for a number of months or, going forward to set an established pattern, and that would generate basically what is called the cash flow statements. So when we look at the cash flow statements, there are key three sections to these statements. One tends to be the operating activities, as was briefly explained in the video. The second is investment activities, and the third tends to be financing activities. So the operating activities would typically be activities which are basically generating, some sort of revenue, income, require investment, and they are basically going to be related to assets and liabilities. And when we talk about investing activities, these are activities which are going to be invested into either purchase of equipment, some sort of, say the business investing into buying premises or any sort of things which are primarily going to be looking at creating some sort of, assets which could be which could be basically looking at company building its infrastructure, equipment, machinery to be able to solidify, business activities. And then some of them tend to be what are called financial activities. And in today's terms, we also look at another fourth, which is the supplemental activities. So anything which does not fit into operating, investing, or financing activities, sometimes they are also put together into the fourth group, which is called supplemental activities. So financing activities, as we saw in the video, was primarily looking at paying down debts, paying down loans, or looking at buying back shares, or if the company is large enough and it's listed on a stock exchange, then you're looking at even buyback programs, which sometimes corporations go into. And in some cases, some of these financing activities could also be looking at issuing long-term bonds, which could be ways of getting cheaper sources of finance when shareholders or various financial institutions end up buying these bonds. Now, when we look at the classification of these activities, what I've done is I've tried to basically put together a few slides to explain some of these three key sections. So when we talk about operating activities, what we generally would associate these activities would be through the generation or the funds or the money which comes into the company through the generation of sales, purchases, or expenses. So in some cases, when we look at preparation of these cash flow statements, we also have two different methods through which this can be done. And sometimes companies would prefer preparing the cash flow statements through what is called direct presentation, and sometimes they do it through indirect presentation. Now, the difference between direct and indirect presentation is that the way operating activities, the way investing activities are typically depicted are going to be slightly different in the two cases when these statements are essentially prepared. But direct presentation tends to be more because of the fact that it lists out the cash flows, the individual heads from which the money is coming into the company quite clearly, and they would separate out separate fields for basically cash being generated from sales. What kind of sale is it? Is it sales from websites, sales from retail, sales from distribution? So it basically presents the information in a much more detailed and structured manner. And this method, sometimes is rarely used because of the fact that it gives out a lot of information to competitors when these statements are published. But the more common method when we look at in terms of using for the preparation of these cash flow statements tends to be the indirect method, because here the operating cash flows of the business are essentially presented in the reconciled form of what is something similar to what a cash profit and loss account or a profit to cash flows account tends to be. So basically a P&L account, but without giving out detailing of how the cash flows of the company are actually being generated, how the money is essentially coming into the business. Now, when we talk about investing cash flows, we also look at what does that term investing cash flows for me mean. So if I look at from a point of view of small business, I would look at any sort of activity which is going to help me buy or get some stock inventory, which at some stage I would be able to sell in the business, or the business would be able to sell, and that would help in generating money coming into the business. When we talk about investing cash flows, we also talk about anything to do with PPE, as we call it, property, plant, and equipment, and this could also include some of the non-current assets and other financial assets. So when we talk about machinery and other bits being bought, then they are normally also called as what is called the capex or capital expenditure, which the company is doing. And what you're going to be doing is spreading that across in your profit and loss, in your cash flows, in your balance sheet over a period of time, in order to realize either depreciation or any sort of amortization which needs to be done to spread that cost not just in 1 year, so that it is spread across a number of years. Now, some of the examples where we look at also these from a point of view of non-current assets could be investments which the company is doing into things like intellectual property or for example planting equipment, which is not going to be say for example let's say realizing all the money, or realizing the company will not be able to realize the benefits of it, and that would happen over a period of time. And when we look at financing cash flows, here we are primarily talking about activities that result in basically the company looking at borrowing more money in order to expand the business. So if you're a small business and you need, if I relate that to overdrafts, or if you need, bank overdrafts to be able to make salary payments for a couple of months initially in the start of the business, what you're going to be looking at basically is financing cash flows. And here, if you take up short-term loans, then you would have the company or the business would be looking at making some loan repayments from month one, but also would be looking at making some interest payments on that loan in order to ensure that the bank is able to provide that overdraft, which could be initially for the purchase of equipment, paying salaries, or any such expense which the company is looking at taking up for short term. And in the long term, this tends to be when companies looking at buying, say for example, or investing into a situation would be a large situation could be in the case of, say, a company buying another company, and sometimes they look at financing these cash flows because there might be an immediate expense in terms of the outflow which will be required to buy an asset or buy another company, or an activity which is generally not expected in the company's calendar of the financial year, but because it is an event which is happening either to change the direction of the business or strategically acquiring a business, then in some cases you would also see some of these requirements which is in terms of financing cash flow. Now, for us to look at in terms of what a cash flow statement looks like, and in this case, if I look at showing the cash flow statement of how it looks like, this is how we would see the cash flow statement looking like, because we'll be looking at dividing into 3 different sections, and these sections would include operating activities, investing activities, financial activities, and anything which cannot be put into any of these 3 broad headings you can also put them into what are called the supplemental activities, and this is what will be a statement looking like. Now, this is obviously for a large company like Amazon. I've just taken a screenshot of their cash flow statement, which was published in the annual general report, and these figures are in billions. So obviously things like when we talk about operating activities, it includes things or broad headings like stock-based compensation, operating expenses, deferred income taxes, which the company would be doing, changes in inventory, accounts receivable or payable. That means it's taking out an extended credit line with its creditors or suppliers. And in those cases, they would be looking at booking this under, accounts payable. And when you look at some of the investing activities, you're looking at, if there is any sale or say, for example, money which is being realized primarily from a sale of an equipment or an asset, which the company is looking at doing, that would normally come up, here in terms of investing activities. It could be acquisitions. If the company is looking at acquiring a business or needs initial capital, which is again being borrowed as an overdraft or taken out as a long-term loan, would be reflected here. And when you look at financing activities, it could be looking at financing its long-term debt, which is looking at, interest payments in order to decrease its overall liability. They might take up another loan or a bridge loan, as it came up in the video, and that is a loan being taken out by a company for a short-term period to basically make adjustments to its cash flow statements so that they are able to either keep up with the loan payments, repayments which are required to be done, pay wages and salaries for workers in a large company like Amazon, and these kind of activities would be reflected into what is called the financial activity. So this statement, when we look at, would be allowing us to primarily get into a couple of things when we look at information or golden nuggets that we want to bring out from this particular cash flow statement. We'll be looking at what the statement will actually tell us, and some of the points that the cash flow statements are important and why and what information they give us typically include, if I have to sum it up, it basically gives information about the finances of the company from the operating activities which the company is actually carrying out. So this would mean in terms of what kind of earnings it is getting in terms of its sale, what is the quality of profit it is making, essentially in terms of whether the cash flows are stable, income coming into the company is stable, and the outflows are being minimized or are kept at a particular level, which allows the company to keep increasing the income and keeping the expenses lower, and that would reflect on the quality of profits or the earnings which the company is actually doing, and that will be the most important indicator that we get out of when we look at cash flow statements. The other thing which cash flow statements would also be looking at is from a point of view of when we again look at small companies, might this point might not be relevant, but when we look at medium to large size businesses, sometimes you would look at shareholders and stakeholders in the company which have vested interest in the company, would be looking at the cash flow statements to see, is the business generating enough cash. So when we look at the example of when we look at the example of Premier League in the UK, you see a lot of these large clubs. When you look at even clubs like Barcelona, look at Juventus, you look at Manchester United, City, you look at Liverpool. All of these clubs, Real Madrid, all of these clubs have large amount of debt which runs into billions of dollars or pounds. So Manchester United, for example, has a debt of 2.2 billion pounds. But why do we see investors coming back and investing in this club or buying the club? Is because the club generates in excess of 440 million pounds worth of cash flows every year. That means it has enough its activities, which is around merchandising, sponsorship deals, the Premier League participation into other types of leagues which they do, Europe, things like that. That is able to, and the fans or the spectators which come across to the stadium to watch these matches, the sale of tickets, all these activities of the club actually generates a lot of income. So when we talk about the income the money which the club is able to generate by doing some of these activities, which is what we term as cash flows, we see the club and the club's activities actually generating in excess of 440 million pounds every year. And that's a lot of money which a business is generating. And that money allows the company as a business to pay back debts, long-term debts, any investment which has been done by owners, or when they look at buying and selling of players, when these windows open, you would generally see a lot amount of transactions being done in terms of getting players into the club, the best talent into the club, and that all these activities are basically financed through the cash the business is generating. And this is coming across from the sale of tickets, merchandise. You look at sponsorship deals. You look at season holder tickets, lots of other associations which they do when they do go out and play, charity matches and other type of activities which the club does, and loads of it. There are in excess of 117, 118 activities which Manchester Club or Manchester United, Manchester City end up doing in the year, and they start from social media deals, sponsorship deals, and all this is generating income for the club. So why is this important? Is because the business is generating enough cash in the year in order to be able to pay back these long-term debts which has accumulated. And when you look at these kind of things, you would generally see that the information which is required for us to glean from the cash flow statement actually comes across from this bit of information that we see: money coming in, money going out, what is the money being used for, and is the money being used for successively bringing down the expenses in order, if the company is looking at, let's say, for example, renovating the stadium, or, for example, doing certain activities which will allow it to bring more income, or increasing capacity in terms of the stadium would allow it to bring more income in the future. And that is where the financing side of activities or investing side of activities will be looked at. So in general, when we look at cash flow statements, when you look at Amazon as a business, the reason I've picked this up just for the purpose of understanding is, when we look at the Premiership, when we look at Amazon, everybody is buying stuff from Amazon today, and we look at this company has not generated enough profits. I think in its history, it's just generated profit only in the last 2 years. So it has been a loss-making operation, but because the amount of cash it generates from a point of view of its activities, which is the trading activities, the Amazon store activities online, is in excess of $400 billion. So when we look at the amount of cash it generates, this is something, when we look at the statements of Amazon, or when we look at the cash flow statement of Amazon, it's published at the end of the year, you're able to draw out a lot of interpretations from that statement, that where is the money going, where is the income coming from, where is the income which is coming from is being spent, how much of that income is being invested into assets which Amazon is creating, which is in terms of data centers or offices or premises and things like that, and how much of that is being given out as dividends or as bonuses or long-term stock option plans to the owners, the management. All that is visible from the cash flow statement. So these statements are very important from a point of view of knowing where the nitty-gritty and the operating expenses of the company, or the sales or the revenue which is being generated for the company actually comes across. And these statements are very important because when we look at profit and loss and when we look at balance sheet, they kind of try and give us a picture of what the company's position is maybe towards the end of the year. So one of the other reasons why these statements become quite important is that these are generated on a monthly, quarterly, 6-monthly basis, and they are done or generated because the management or the directors of the company, or the owner of the business, is interested in finding out whether the money coming into business is stable, whether we are seeing an increase in sales, whether we are seeing an increase in the activities of the company, which is generating more revenue and turnover of the company. So that is why when we look at these statements, they're quite important. Now, as I mentioned just very briefly, to differentiate between the two methods through which cash flow statements can be generated. These two methods tend to be the direct and the indirect method, and the only difference which is between the two methods is the section in which the operating heads, or the operating section basically the heads which are included in terms of how the company's operating section actually shows information is depicted, and those are the reasons why these two methods are different. Now, the direct methods are more favored by the international accounting standards as against the indirect methods, because in the direct methods, what will happen is that the company would be actually looking at showing the details of the instances of where the money or the cash is coming into the business, and that would be favored by the international accounting standards side. But most companies, 90% of them, basically prefer to do the indirect method, as I mentioned earlier, is because some of the nitty-gritty which they do not want to highlight and show where all the heads or what are the various areas from which this income is coming from, keeping in mind some of these statements are confidential and can diverge a lot of information to competitors, and that's why they would look at hiding some of these by or basically not getting into the details by using the indirect method, wherein the operating section, which explains how the business is operating, where the money is coming from, what activities are generating the income or the sales or the turnover, and those then are allowed to be reflected as consolidated activities under the operating section, and that's why the indirect method is more favored by companies. So when I look at cash flow statements of through a direct method and through an indirect method, there are these differences which are primarily appearing in the operating section. And as you would see that in the operating section, in some cases, a company would show income or income being generated, which is going to show income as net income. It is not going to break it down into whether it's coming from suppliers, whether it's coming from partners, what type of sales being done. Is it indirect sales, as I mentioned earlier, distribution sales, wholesale? It could be website sales. So it is able to put that out as net income rather than break them up into where the operating activities are essentially occurring, and obviously where the income is actually being used to fulfill those activities. Now, we look at preparation of the next with this background. What we want to be able to do is we understand in terms of a couple of things, which is let me show you. So when we start off, let's look at a particular flow chart, which basically helps us understand, which is this, that why do we need cash flow statements? What are the different methods to prepare cash flow statements, direct and indirect, and what are the three key sections of the cash flow statement that we look at, and they help us understand the importance of these statements and the data they provide. And that is where at some stage when we look at directors, owners, when we look at small medium businesses or we look at large corporations, the key people in the financial side, financial controller, you look at the CFO, why they are interested in having these cash flow statements being generated on a weekly, monthly, or quarterly basis is to see what is the position of cash in general within the company. And in order to understand the expenses and the incoming and outgoings and where the money is coming from, these statements become the key factor for them to get a handle on how the company is doing, what are the expenses the company is incurring, where the money is coming from, and what payments can be deferred, what payments need to be made immediately, and that is where the prioritization tends to happen and shows overall the workings of the organization. Now, any questions on this so far? So just with a bit of a background in terms of why the cash flow statements and reasons and types and what information they provide us, we will get into the assessment criteria. So any questions at this stage?
No, that's all good.
Good stuff. Now, the first task in the learning outcome 2 basically talks about preparing a cash flow statement. So what I've done here is I'm going to look at preparing a cash flow statement, and I've prepared a bit of a basic format which I'm going to look at using. And what I will do is basically start off by looking at a simple small company, which is basically looking at how they would look at essentially generating their own cash flow statements. So here, if I just undo this for a second, and go into it. There we go. So here, what I've done primarily is, before I delete, and we do this as a bit of a practical exercise to generate a cash flow statement, what we've done is we've created a few broad headings, which is looking at opening balance. So what is the money at hand in terms of the balance which will be reflected. We've looked at money coming in from a number of activities. We've looked at money going out, from the various activities which the company would do. And then what we are trying to do is arrive at a closing balance. So when I look at money coming in, it could be coming in from various sources. It could be owner's capital, bank loan. It could be from sales. It could be money coming in from other types of activities of the business, which could be if it has cash reserves, which have been invested, if the business has bought a property, for example, and there is income coming in from there, or if the company has invested into pension fund or any sort of other investment which is done, and if there is contributing any sort of interest or regular recurring payments, all those come here in the other form of income. So I've just not expanded that others, but I've just grouped them into other activities. Money going out could be, when we talk about money going out, it could be things like loan repayments, goods for resale, which is the inventory which the company ends up buying before it's, when it starts the business. You look at any sort of equipment which the company has bought, any loan repayments if the company has taken out a bank loan and it has to make these recurring payments, money it is spending on advertising, anything on the website, any merchant costs or merchant services costs. You're looking at postage, stationery, any overdrafts if the company is looking at borrowing. When you look at money coming in, normally the heads are lower in terms of the share count, and we look at money going out, the expenses side of things is what we are looking at, mentioning them as individual heads. Now, when we look at the basic essence of drawing up the statement, I've done a simple calculation from the April 21 to the next financial year, going by what the HMRC financial year is. But companies could have different financial year. It could be Jan to December, or when the company was formed, June to July, or whichever financial year they look at. Now, the idea of generating a cash flow statement here is to look at some forecasts and also to look at how the company's operation would be performing, and that is where we've looked at doing this across a 12-month period. Now, the initial opening balance in the company's account is going to be zero, so I'll put zero. And then if I look at generating this cash flow statement, what I've done is basically put out some formulas in the column. And what I've done is basically formatted the sheet in order to look at when I put them in. So it generates, using a spreadsheet as an example, it helps me do the totals automatically. So here I've used sum as a function. So any figures that I put in will come here, and they have been extrapolated for the following months. The opening balance being zero. If anything is put in here, obviously the next month's balance would increase with the previous month's balance. They have been totaled up in this particular column. And when we look at the total money going out, again, the totals of all the activities for which the money is being spent from the company, and that has been totaled up for the year. The closing balance will ideally be the opening balance plus the money coming in that month and the total outgoing of that month, and that will give us a closing balance in terms of the cash flow statement. So if I look at a small business, so if I look at, for example, business like say, let's say sales, or I would say, say Mancune, just a fictitious name, which is Man and Wan Limited. So looking at a small business, which is primarily, when I say a small business, I'm looking at a micro entity or a micro business here, which is a startup business. Now, this company is basically, is involved in what is called relocation or, movement of office or other things, and they are basically packers and movers. So essentially, if I start off this to make a cash flow statement, which is what we need to do, how do we start that? So for example, if we start with the owner putting in about £1,000 as an investment to start this business, and he also ends up taking maybe some amount of loan, which could be say £500 initially, and then there are sales which we know as of now in month one, there are sales, and that totals up to the total money coming in, because the initial balance when we saw start the statement is 0. And then as we go along, what we try and do is basically see if the owner still needs to invest a bit of money. So assuming the owner is putting in about £100 for a couple of months, or in some months, maybe the owner is putting a slightly higher amount in order to keep the company going. But generally, if the operation, you wouldn't probably look at running the business or starting a business if it's not able to generate and stand on its own feet in the first 6 months or after 6 months. So looking at the owner putting in some capital, the bank loan that has been taken, I'm going to try and put this as 500, and then the bank loan say about 1500, which is what you're looking at 3 times in order to have some sort of a play in the business when you look at buying an inventory or maybe buying a van or something like that. And then say from month 2 onwards, the business starts generating some amount of sale. And in this case, maybe the sales the business is generating, I'm just going to randomly put in some figures, and the sale could be increasing over subsequent months because the company might be increasing, say for example, advertising spend or getting more inquiries from existing customers. And that would be basically informing us about sales. I'm going to leave the others as blank because it's a startup business as we are assuming. So there are no other forms of income coming into the business. Now, because the owner of the business takes out a bit of loan, what we are looking at is loan payments which will start, and they will start generally from month 1. So assuming the loan payments, remain stable for the first year, and they are generally at £20 a month, I'm going to just extrapolate that and then say, okay, that's the loan repayment which the owner is doing on the business. Now, anything that we look at equipment, so maybe you might end up buying a printer, a PC, and that is the cost that you're looking at spending towards buying the equipment. Now, loan repayment costs, assuming this is the interest cost on the loan that you have taken from the bank. And if I put this as a random amount, and that would not change, or essentially over a point in time, it would start decreasing as the loan amount reduces. And this is what I've generally put in as a figure. Now, the company might do some advertising and obviously do some advertising on Google AdWords. So maybe spending about, £20 odd every month. And that is looking at some sort of advertising to generate leads. There is some cost for website hosting, which maybe the company would be paying, every 6 months. So I'm going to put some cost here, and rest of the costs are 0 because it's a 6-month thing. The merchant could be that if the company is looking at taking payments through credit card, online sales, there is some bit, assuming if the sales start from next month, maybe there is some merchant costs of say 2.5%. I'm just going to randomly put in some figures here. And as the sales keep increasing slightly, the merchant cost might go up as well. If there's any amount of postage which the business does from say, it could be postage which is primarily sending out leaflet, flyers, whatever it is. So the idea is if there is any postage which the business is incurring, just putting in some random figures, which the business would look at. In some months it could be higher, in some months it could be lower. So basically looking at putting in some expenses which the company is looking at, doing, whether it's posting out of the invoices, receipts to its customers. And maybe a one-time cost of some stationery, pen, pencils, calculator, basic stationery that you need in the office. You might buy them, at certain intervals, and there would be certain costs to it. So you put that out. Maybe you're buying in, some amount of stationery required every, maybe 3 months, 2 months, whatever it is. If the company has taken any overdraft, the overdraft payments could be, to look at maybe generating or having enough capital to take on some expenses. The overdraft payments which and assuming they have an overdraft, this is going to be say consistent. I'm going to put that in. Salaries, which will start from day 1, assuming the owner is taking some salary. So I'm going to put in say £200. And, this would be consistent. Another staff, and that would increase the payments to 300. Continuing, the business is growing, maybe another staff. So I'm just putting on some numbers here randomly, which is basically the income which the business is getting, but also the outflows, because as the company starts expand, maybe the income in terms of salaries and wages will also go up. Now, this would help us arrive at some sort of figures which are basically showing the amount of cash the company has, the amount of cash which is going out, and then goods for resale would be. So here, if the company has, say, for example, because we talked about a van and van, I would say higher purchase cost or HP cost, for the van. And if the business has bought a van initially for which the loan was required to make the initial payment, and the higher purchase costs, are about, say, £299 a month, this would remain fixed over a period of time. And if the company ends up buying another van, maybe after 6 months as the business is increased, they might go to, say, £498 because the business now has two vans, and that is paying some higher purchase costs or repayments of the loan which is happening, and that would be factored in here. Now, this for us, if I look at for example, from a point of view of money coming in into the business, would be basically giving me some idea in terms of what is the money coming in, and if I look at money going out from the business because of various activities. Money coming in, money going out, and then the total closing balance at the end of the month actually tells me that the business activities are pretty much stable, and in some months the business is generating more income, and the income is more or less steadily rising, but there are some drops which are happening in certain months, like in this month there's a drop which has happened, and then it starts to increase again, and that is fine. So if I get into the details of it, why this drop has happened, we could look at by getting into the details of where the money has come in or where the money has gone out. It would tell us maybe the company has bought or the business has bought maybe some equipment, or in some cases invested into some sort of asset. And here when I look at the income drops is because the company buys a second van, and in this case assuming the loan repayment, because it might need to take out a loan again, and here if I put say another 1,500 taken out, and here the loan payments then start to become £40 because of the fact that the loan has been taken out. You would see it'll show us why the dips in cash flows are happening, and some of the things which I'll be able to see is that the money going out is steadily increasing. In what percentage it is increasing? Is it increasing in any spurts, or is it showing some sort of a regular pattern? And then once they've added the second van, as the businesses start to increase again, the revenue or the money which the company is bringing in from various activities of removals is essentially doubling up after 6 months as the business becomes more stable. And in terms of total money which the company has at any given point in time which is coming in, actually if you see significantly decreases or only shows an increase when the owner is actually taking up a loan, and when that loan is being used to buy the asset, the income actually increases. But apart from that, there is no other fallback mechanism which the business has, because the business does not have capital reserves in this stage in the first year. It has limited capability to take up loan, because when the loan is being, if you go to the bank and you're assuming, if I relate this to a personal situation, that you're looking at buying a house, so you want to take out a mortgage. Sometimes when you go to the bank, what the bank and the mortgage advisor is going to ask you to do is provide a list of earnings that or a list from which they would want to see where the income is coming from, where is your earnings coming from. So they would want to look at things like wages, if you have any cost in terms of interest, or any sort of windfall which could coming in, which is money coming in from your parents, or somebody helping you, or is there some sort of a loan or other bits that you've taken out. So they want to understand the nitty-gritty of what is your situation on finances, money coming in, money going out. Then they ask you to fill up a sheet wherein they say, okay, can you fill out your expenses, assuming your salary is £5,000, and what they look at then is to look at what are the outgoings, gas, electric, your rent payments, your HP, fuel expenses, food, clothing, any schooling costs, things like that. And what they want to do at the end of it is to see what is the net saving or the money which is left from the incoming, which is your salary, and what is the outgoing and what is the net which is left. Now, what they will look at some stage with that is an exposure to see what is the liquid income or the liquid money you have every month to be able to invest. And basis your overall salary in your financial position, the bank would look at lending money to you. And they would ask you things like if you have any debt on credit cards, are there any loans which are being repaid at this moment, you have an asset or a car or any sort of other asset on a hire purchase when you're making regular payments. And with that, what they'll look at is calculating exposure in terms of how much can they lend to you personally for you to be able to look at buying or affording a mortgage. And that is what is called affordability. So similarly, in the case of business, when this has to be done, sometimes bank will ask you, not sometimes, or banks will always ask you to provide cash flow statements. And in some cases, projections are also required because they would want you to look at from their point of view. They want to understand what is the position of the business as of today, where the position of the business, how the business is looking at moving ahead, and what is the income or the source of income it has, and what kind of income it generates on a monthly, quarterly, and on a yearly basis. And this would help them estimate the exposure to the loan or the overdraft which the company is requesting or the business is requesting. And this bit of information will actually come from the cash flow statement. So in this particular activity, which we are looking at, is we have to prepare a cash flow statement, and a cash flow statement can be prepared for a small business. You can look at your own organization, you can look at a sample organization, and what you could do is prepare a cash flow statement which will be, looking at meeting the requirements for the first criteria of the task, which is looking at preparing a cash flow statements from a given data. So in this case, it's a blank canvas. You could pick out anything in any company and then draw up this cash flow statement, which will essentially allow us to complete the first pass of the task. And, as I mentioned earlier, the statement would, when you do the preparation of this cash flow statement, the idea would also be to make some notes or make available some notes. And these notes would tell us, 1, 2, 3 notes would actually tell us in terms of what the cash flow statement is, basically telling you about the business. So maybe some assumptions in terms of whether you're looking at it's a new business, it's an existing business, it's a startup business or a small medium business, and those could be explained in the notes. When I talk about notes, like I mentioned things like when I say notes, so I would like to make notes on, say, for example, advertising. And what is the note on advertising? The advertising note would be that the company is looking to advertise on Google Ads, and this, so basically Google Ads, and that's the monthly expense. So when I talk about, notes, this will be helpful for, people getting hold of your cash flow statements to relate to what the expenses are or what is the reason why the money is coming in, why the owner is putting in money. So the other could be, when I look at website, I would say 6 monthly, payments for the hosting of the company's website. And then the other bit that I could also explain is that in some cases, like when the loan payments are doubling up or why the second loan has been taken out, so you could make a note here and provide that under notes, explanatory notes for the cash flow statement is say the owner or say the company has taken or, has, say, for example, taken out another loan for the hire purchase of a van. And these would explain, the key points of how the, expenses and, the money inflow and the money outflow is happening on the statement. So is that okay? Is that understood?
Yes. Yes, good.
Good stuff. Now let's go to the second assessment criteria, which talks about what are the key, points or key takeaways that we get from a cash flow statement. So when we look at, a cash flow statement and we look at this particular flow chart, it gives us the key reasons of why these statements are required. So for example, it helps us assess liquidity of the company, future cash flows. If there are, if like I've done a projected cash flow statement for the financial year, and what the business can actually generate, and then what kind of investment decisions which the owner or the company can make can be seen from what cash the company is generating in from its activities. Now, one of the other requirements that we look at is the standards requirement, which is the IEA standard requirement 7. And that basically, is the standard for statement of cash flows. And it requires the presentation of information, about any sort of historical changes that can happen in the cash flow statements, or when cash equivalents of any entity by means of statement of cash flows are drawn up. And that helps explain and meet the standard requirements that during this particular accounting period, this is the amount of investment, this is the amount of operating, and this is the amount of financial activities or type of financial activities the company is actually doing, and those are classified in the 3 sections of the cash flow statement. So basically, IEA standard is required to be followed when generating this cash flow statements, and we need to group them into these 3 broad key sections, and they always tend to be operating activities, investment activities, and financial activities. If you relate this to the US, in US there's a 4th category as well, as I mentioned earlier, which is the supplemental activities. So any activity which the company does cannot be grouped into either short-term, investment, long-term financing, or operating activities. They could group them into what is called the supplemental activities. Now, the preparation of the cash flow statements, basically shows the current and the previous position of how the financial situation of the company is. So normally when you start looking at comparative cash flow statements between this year and last financial year, what you're looking at doing is understanding from an investment point of view, stakeholders point of view, shareholders point of view, from a regulation point of view, that how is the financial position of the company improving? Is it becoming, difficult? So when we look at the COVID-19 pandemic, a lot of companies have seen a decrease in their cash flow. So when they do their accounts this year, it will show a reduction in profits, reduction in revenue, turnover, and this will be evident when we look into details of the cash flow statements of this year and compare them to the cash flow statement of last year. Because of the lockdowns and successive lockdowns, the companies have not been able to involve or indulge in sales activities or activities. And if the company does not have an online presence, what you will see is generally the statement of cash flows this year would have shown a decline. And in some cases, some companies would have looked at, selling off certain assets to shore up the cash flow which is required to keep employees on roll, or, do and perform other activities. And they will also be coming across as detailing when we look at the cash flow statements. Now, the bit that we need to look at after understanding all this process is to understand what information you get out or you take away when you see or read or get hold of a cash flow statement. So the useful information it provides when we see these statements is basically 3 or 4 main points only, and they can be further divided into various depending on the size and scale of business. One is, it clearly tells us how much you are spending and how much you're receiving. So money coming in, money going out. That is a fundamental point that we get from these statements. Now, if you had to look at a balance sheet, that would tell you at the end of the year. If you had to look at a profit and loss account, some companies generate that 6 monthly, some will do this annually, but generally you will get that situation or that information on a periodic basis, and that would need to include a lot of other things which will be required to go into these statements, and they would not give you the nitty-gritty of what is required to understand money coming in and going out. And because they are generated maybe towards the end of the year, it is going to be detrimental for the, you need to look at them from a perspective that they don't give you the information as of date or as of for tomorrow. And in those cases, you have to look at cash flow statements. And last but not the least, why do you look at these statements from a financial decision-making point of view is that the owners, the directors, the management of the company needs to make decisions which are based on the finances of the organization or business, and those decisions tend to be based on money coming in. So if you decide that I want to invest into an advertising campaign next month, what you would do is basically look at your bank account, see what capital reserves you have, and after that, what you would do is, if you're going to be spending a lot of money, you would look at how this money could be appropriated over a successive number of months, and for that you would need to see projections, or you would need to see statements which are cash flow statements, which allow you to get a handle on the activities of the business and what it is going to generate in the future, and whether you'll be able to pay for those activities from the generation of that income or not. So some of the questions which come to our mind when we look at why is cash flow statement important? What kind of information they provide? So they would answer questions like these, which are, listed as bullet points. Things like, has the cash in the company increased or decreased over a period? So as most companies have seen during the pandemic, cash reserves that they have actually gone down because a lot of cash has been used up to pay for premises costs, for rental costs, for employee wages, certain payments and repayments which are happening, which cannot be stopped. But because there is not enough sales happening, you would see the cash in some cases, with lots of organizations and businesses during the pandemic going down. Then we look at how, material, for example, inventory is increasing or decreasing in the company. So that will also tell you have more payables or more receivables. If the inventory is high, then you have more payables. If the inventory is low, that means you have receivable. That means goods have been sold and you're looking at realizing money from customers. So lots of these type of questions, things like how much you want to spend, and when we look at minimum order quantity, specifically when we talk about inventories, we look at how much does the company invest in inventories. When do the reordering of the inventory actually start? So reordering levels are defined, and that is defined to keep in mind that it does not interrupt the cash flows or comes in heavily or weighs in heavily on the cash flows of the company. So when inventory ordering is done, it's normally done in spurts, but now companies are looking at defining what are called the reorder levels. And if a level of the inventory, which is currently a product being sold, if I look at Amazon, and if it falls below a certain level, and they know that they service, say, 200 orders a day, and if it falls below, say, 400, then the company would do another reordering of 1,000 of those quantities in order to sustain 5 or 6 days of, and then to add to that, you add lead times in terms of what will be required for that inventory to be replenished and things like that. And then the other sections, when we look at these questions, essentially, we can divide them into, 3 different sections. I can divide them into, what are called the operating activities. I can divide them into investing activities. I can divide them into financial activities. And these kind of questions that we need to look at answering can be done only when we try and interpret the financial statements, or basically in this case, the cash flow statement. So that is what I've explained in these 3 different slides. So here, in order to do this particular task, what I would suggest is when you look at drawing up this particular cash flow statement in task 2.1, do so for a company wherein you define and create a bit of a project statement for a couple of months, and then explain the notes in certain months wherein you're showing a spurt, decrease, increase, higher expenses, higher money coming in. And then in the part 2 of the task, here would be to interpret this statement with regards to what you presented in task 2.1. And that would be a practical way of looking at explaining and interpreting the statement of cash flows. Is that okay?
Yeah, that's fine. I mean, a lot of it is actually is quite clear. It's just the analogy. I mean, basically we do cash flow forecasts all the time for people, but not really realizing you're doing a direct forecast, whereas the indirect cash flow forecast, which you see in accounts, are normally only applicable to sort of like medium to large size companies. So it's it's been a bit of a strange one. Didn't realise it's something I actually did, but it's not something you would actually be preparing for publication in Companies House, if that makes sense.
That is correct. Yes, absolutely. So the only difference between the direct and indirect method tends to be the operating section of the cash flow statements. And obviously, when you look at submitting accounts to Companies House, most companies look at submitting the abbreviated accounts rather than the detailed accounts. And obviously,
What I'll do is I'll email you an Excel model which a friend of mine developed many years ago, and basically it's something we use for actually forecasting. And there's lots of different apps out there at the moment, but I mean this is something that's quite good. It works from like the forecast, and from it you're building a P&L and balance sheet. But at the end of the day, it's quite good. But I mean, the way you've laid out makes it very, very clear, and you've demystified something from which I used to beat myself up, and now realise I never needed to.
Great, that's great. Right now, just going forward into so when we do the interpretation, generally the idea of doing the interpretation is to understand what are the benefits and what are the drawbacks of doing cash flow statements. Now, in small businesses, just sole traders or partnerships, generally, the cash flow statements might not be of that much of importance after the initial, when the business is being started. But at some stage, they start to do these because of the fact that we need to bring predictability into the running of the activities of the business. So in the subsequent one or two slides, what I've tried to do is basically provide what are the benefits of why cash flow statements are important and why they are needed as one of the statements which are drawn up at the end of the year, and they are now published in at least this medium, rightly said, the medium and large corporations or large businesses, because there is substantial amount to report in the cash flow statements or accumulated cash flow statements for the year. So there are some advantages and some disadvantages, and they have been listed here from a perspective of understanding, why you would do the cash flow statements, and the advantages being that it explains the liquidity in the business. It explains things like, where are the major, who are the major contributors of income coming into the business, and where the estimated cash flows are going. And in terms of the drawback, we look at, being that some of these statements tend to be backward looking, which means that users normally look at, when companies look at accounts, and when investors look at accounts or banks look at accounts, they normally end up looking at profit and loss statements and, balance sheets rather than looking at cash flow statements. Yes, for a lot of operating large and medium businesses, we see that these statements become important because they are generating a high amount of cash or high amount of income on a monthly basis. And when they look at their requirements of acquiring, so for example, the case of mergers and acquisition of business buying out another business, and if they're going to take out and go back to the bank or investors to ask them to invest, they would need to draw these statements up, because they will show the nitty-gritty of the transactions being done and how the money is coming into the business. Now, the third task relates to making justifications or recommendations to the business in terms of how the cash flow can be improved. So if I look at the example that I've taken here, what I would need to do in the task 2.3 is, if I follow through in this example, I would need to basically make justifications of how the business owner in this case would be able to improve the cash flows of the organization. So in some cases, you basis the assumptions that you made in the initial beginning when you've given some notes. What you'll have to do is make some recommendations to the business, maybe through some bullet points. And if you take that same example up to explain how the cash flow of the organization could be improved, and you could basically let's say categorize them into broad categories, like where how the owner in this case could look at improving the cash flows of the business by looking at operational side of things, tax and interest side of things, looking at any of the investment activities, financing activities, and anything which is to do with CCEs or cash and cash equivalents. So they would be basically the remits in which you would be looking at making some of the recommendations. And again, here, the idea would be to try and focus on, the recommendations of the business as a startup business is not following, say, for example, the standards which are defined in the IES 7 standards for generating cash flow statements, that whether the 3 sections are there in the cash flow statements or not, and whether the profitability and liquidity of the business is being, depicted by that cash flow statement. So what kind of money it generates, and at the end of the year, is the closing balance higher than the opening balance, or is the closing balance lower than the opening balance? That would need to be looking at recommendations that you could make with the example that you take for doing this particular task. So again, this one would follow task 2.2, wherein in that what you've done is interpreted the cash flow statement that you provided after making it in task 2.1. In 2.2, you interpreted it. In 2.3, you're making recommendations of how this cash flow can be improved, and that would help basically look at achieving this particular task. Now, having understood, if I look at generalizing what recommendations can be made and why sometimes you would look at cash flow statements being important to different users when they look at them, they would basically give out some information, and these information would be coming through from when I interpret and make suggestions on these 5 broad areas. So these 5 broad areas I've highlighted here in the slide is that they help users to assess liquidity and solvency. They will look at helping you assess financial adaptability of the organization. So if the van, for example, in this case, is to go out of operation, or if there's an accident, or for example, it becomes unusable for a number of weeks, then how would it impact the cash flow of the company? That means there would only be one van available. That would mean decrease in some of the business which the company is able to generate, or field the inquiries that it is getting for relocate, removals and other things. So they would be looking at making recommendations in terms of contingency plan that the business or the business owner should have, that they should be able to hire a van from other providers on a daily basis to not have the business impacted or the cash flows of the business impacted. And these are the basic interpretations or recommendations that you would make by assuming that this is the problems the business could face, and against those problems or issues which the business could face, you would be looking at making some recommendations to negate them or basically overcome them. Is that okay?
Yeah.
Now, there are 2 additional criteria in this particular task. One is a merit criteria and the other is a distinction criteria. The merit criteria talks about evaluating the significance of information which is given in a cash flow statement. This would again refer us back to the 3 key sections of the cash flow statement that we generate, which are basically related to the operating activities, which are related to the financial and the investment activities. Or what we have to do is basically explain the nitty-gritty of these 3 types of activities and why the broad headings allow the companies to group some of these into these 3, and what kind of information does it provide to readers when they try and interpret this statement. So a couple of points that I'll quickly go through here would be when I look at operating activities. Now the operating activities, as I clearly understand and we all know now, that it helps basically understand what is the cash generated from the company's operation. So when we look at these activities which are grouped under the operating activities, what we want to understand is whether the cash being generated from operations and how is it compared to the cash or profit being generated from operations. So there's a slight bit of difference. Cash generated from operations means then when the company looks at engaging into activities of sales and looks at calculating it and tabulating its expenses, that would be looking at the cash which the company is bringing in. But when I look at profit from the operation, what would happen here is the input costs which are required to sell the product and the manufacturing costs for services which the company is utilizing to produce that final bit of product and then sell it to the consumer, in this case, would be the net profit which is being generated from the sale of those goods and services. So here, when we compare these 2 together, which is cash generated from operations and profit from the operations, they tell us what is the quality of profit. Is the income on the cash, say companies, books going up, and is it going up from operations which are basically leading to more sales, or is it going up from operations which would be savings which the company is actually making from negotiating a better contract terms or credibility terms or better purchase price from its suppliers. So that would tell us whether this is short term or whether this is long term gain which the company is making. So if the profit from operations is going up, that means the company is actually generating enough sales which will regularly bring in cash, and that shows us a position of strength in the cash flow statements. But if it is being generated from operations wherein it is negotiating better credit or it is negotiating better price from its suppliers, then this part of the position in the cash flow statement essentially would be, showing short-term liquidity. That means there could be problems in the business wherein it is trying to generate cash from other non-performing or non-regular activities as against regular activities, which is to focus on increasing its sale of goods and services, or whatever the business does. Now, what are the other inferences that we can draw from this would be that when we look at if the company has large receivables, that means you have done a lot of invoicing, and that invoicing is pending for payments. That means the company is also looking at racking up debts, even though it is being projected as sales within the cash flow statement, but whether actually that money will come into and will be realized into the statement would remain to be seen in the subsequent month. And that would also show us a position that the company has a lot of receivables, that means it could also be turned into what is called the irrevocable debts. That means bad debts, customers not ending up paying, or in some cases, dependence on one customer for a lot of business or a large amount of business. And that would also show insecurity from a point if the customer is to go under or not be able to make the payments, then the company would immediately looking at seeing a visible hole in the cash flows in a particular month or a period of couple of months, depending on how the invoicing has been staggered. Now, the other bits of information that we slightly look at from getting the operating activities is that whether in some cases the cash being generated shows a positive figure on a day-to-day basis or not. So in some cases, what happens is sometimes companies, when we look at even small, medium businesses, and we look at small businesses, in some cases, what tends to happen is when you look at the cash flows towards the end of the month, when there are a lot of outgoings like wages, rent, other payments which have to be done in terms of loan repayments and things like that, taxes have to be paid, or PAY has to be paid for small businesses when they are paying their employees, contributions have to be paid. You would normally see that this side of the cash flow statement, when we see that reflected in the operating side, shows that there is a sharp decline sometimes towards the end of the month, and this is primarily also which can be predicted if it happens on a month-on-month basis. And how the company can look at improving this is by staggering the amount of repayments it does over a course of the month, rather than doing it on a fixed date, either at the start or at the beginning or the end of the month. But they should be able to stagger this in order to ensure that the cash required to run the business on a day-to-day business basis does not get affected, and it is able to spread its costs by looking at aligning these outgoings going at different intervals of time in the business or from the business. We look at certain key points that come out of investing activities when we look at the cash flow statement. So here you're looking at non-current assets, and an example of these when we talk about non-current assets tend to be anything which the company has actually purchased in terms of equipment, or in terms of long-term investment the company has done, which could be in terms of taking up premises, or if they've taken up a new premises, if an amount or a deposit has to be given, which is securing the premises for a period of as per the contract, say 2 months of deposit, that would mean there's a large amount of outflow it might need to do in terms of paying that as a deposit towards the leasing of that premises or buying a property or equipment. And in those cases, you would generally see that in some cases, if this is to happen, then what we generally see that the company is trying to invest in activities. And the case in point that I've taken is that sometimes you see during the pandemic, some companies have actually sold off their assets and have gone on to rent in order to keep the business going. And that which has been done to shore up the financial position of the company, for a short period of time. But essentially, if this is done and they have to go to the bank to take out loan, what this would mean is that the company has less assets to secure the loans against, and that would make their financial position when they have to go out and seek credit or get long-term loans to shore up cash flows in the company would be actually seen less viable or less friendly because the company's position is weak, that they do not have any assets to be able to put that across as secured or securables against a loan or money that they are trying to borrow. Now, in one case, on the other side, one of the other aspects that we also look at is that in investing activities, you also see sometimes you're able to spot what is called poor cash management if the company is not managing its cash flows properly. And this happens typically when you see the company's products and services shrinking. That means if the company is seeing a decline in its sales or decline in the services or products that it provides to customers over a point in time, and if this is not being looked at and improved, then what it will show is that the overall position of the company in terms of its sales and services which it is providing is also shrinking. So when we look at investing activities, when we look at financial activities, and financing activities, you get a lot of key bits that we can interpret when these cash flow statements are drawn up, and that is what is required to be done. And now you can relate this to the cash flow statement that we have prepared or you're going to use in your assignment, and then basically group them to cover this task. So I have generically explained some of these things because these are interpretations which normally can be drawn up when we look at in detail studying what kind of points or let's say inferences we can draw from the three different sections of the cash flow statement, which tend to be operating, investing, and financing activities. Any questions on this so far?
No, that's fine.
So the last one that we look at is briefly, evaluating the usefulness of statements of cash flow statements. So here we are going to be talking about advantages and limitations. So these can be, done generically, and that is what I've done here on the table by showing what are the advantages of cash flow statements and what are the limitations of cash flow statements, for organizations. And what I would suggest is after putting this across generically, you might want to do a quick slide to say and relate this, or maybe 20 to 30 words to relate this to the company that you've taken in order to prepare the cash flow statements for task 2.1. So basically, everything in this particular learning outcome will follow through from 2.1, the cash flow statement that you prepared, then go on to basically doing, the interpretation of the cash flow statement, make some recommendations to say how cash flow can be improved, and talk about, in general, the three sections and why they're important to produce when the cash flow statements are being done or produced, and then mention the point of the IAS 7 standard which is required. And then in the last, we talk about the advantages and disadvantages of cash flow statements for that same organization for which you produced, the task in the cash flow statement in task 2.1. So with this, we come to an end in terms of, our discussion for the learning outcome 2, which is be able to. So that means here you will have to practically take example of a cash flow statement or prepare one and present it in the assignment. And that is where this will follow through in completing some of the assessment criteria. Towards the end, we're going to quickly do a quick bit of recap with about 3 or 4 questions just to look at testing our knowledge in terms of what we've understood from today's session. So multiple choice quick questions, which is looking at, in terms of checking what we've understood with regards to the cash flow statement. Shown the answer already. So the first one is, which of the following could appear in company statement of cash flows?
Well, it's going to be the cash in, isn't it? It's the dividend.
Yeah,
it's the dividend.
Yeah. So correct. That's correct. That's the dividend. Yes. Now, when we look at depreciation expense, what kind of an expense is it? Is it operating, investing, financing? And I've also included what is called the supplemental, which is sometimes used if you can't group them into any of these three. So what is the depreciation expense in this case? Is it operating, investing, or financial expense?
In this case, it's operating. It's your how you relate the expense over the period of life of the asset.
That is correct. So it will be operating expense because when you say, for example, buy a say, a piece computer equipment for £1,000, you would look at depreciating that over a period of 5 years or 3 years. And what you're looking at doing is book that as a expense, but put it into your balance sheet as an income or under the asset when you book it, and that will be coming under the operating side of things. Now, proceeds from the sale of equipment used in the business. So if the business looks at selling any of its equipment which is either obsolete or realizing some value from the equipment, what would that be looking at reflecting into in the cash flow statement? Will it come in the operating, investing, financing, or supplemental?
Well, it's money that's been piled back a bit. Are all the answers highlighted?
It is, yeah. Just put them on there. But yeah, the main point is yes, the answers are highlighted. But the reason is what I want to understand is.
Yeah, I mean, basically, I mean, it's not something that you're not selling on a day-to-day basis. It's something you have actually used in the business. So if you actually have sold it, you actually plan that money back into the business. So it is actually investing.
Yeah, that is correct. So the reason is, as you explained, if the company looks at selling a piece of equipment, and what it is trying to do is maybe generate short-term cash to be able to invest into further activities, and that is where the idea would be that if it's not requiring anything that is of use, and it could be sold, and that cash can be generated, could be invested into some of the future activities which the business is planning to do. Now, the loss of sale of equipment in question 2, assuming if the business sells the equipment, and the whole idea of doing or selling the equipment was to generate some cash, but in doing so, it has overall landed up into a loss or an overall loss from the sale of that equipment. Where will you book that in the cash flow statement? Will it be booked in the operating, investing, financing, or where will that be booked essentially?
It's operating.
Is operating, because the loss, is basically to be, is the money which is not. You were trying to realize some money by the sale of that equipment, but because that would have had some HP payment, some interest payment, or say for example, certain amount of capital which was still waiting to be repaid or was looking to be repaid after the sale was being done. But overall, you've ended up in a loss. So in that case, it will be shown on the operating side. An increase in the balance of account receivable.
It's operating because actually it's more money that you actually owe for things that you've actually expended in the day-to-day running of the business.
Correct. So the accounts payable are generally, booked in the current liability account. So when we look at current liabilities, or you look at assets and liabilities from a balance sheet point of view, anything which is other than cash, which is increase in the balance that you are looking at from a point of view of increasing the financial position or cash the company is generating, would be booked into the operating side. Now, the amortization of the cost of intangible assets. Where does it?
It's the same as depreciation, so it's going to go into operating expense.
Absolutely correct. Yes. So it is. Yes, that is correct. So it will go into the operating expense because this is looking at reducing the overall expense the company is actually incurring from maybe the income it is able to, say for example, derive from the equipment it has bought a couple of years back, and that equipment is now paid for itself, and the income that it now generates is primarily, cash flows that the company is getting. And that is where you look at cash not being reduced, but basically being, increased. So that would cover that side of things. So yeah, I think from our point of view, I can understand that yes, with the quiz and the answers that have been done, it gives me a good understanding that yes, the basic bits of the preparation of cash flow statements and how we look at some of the operating heads which are put into the 3 key sections: operating, financing and investment side, allow us to understand how do we differentiate between these headings, and then prepare a cash flow statement which depicts the position of the business in terms of money being brought in or expenses which are going out. So that helps us cover learning outcome 2. And it's a bit of a practical one. So in this case, you'll have to look at doing the statement, preparing a cash flow statement, and then this would allow us to address all the assessment criteria here. So as always, I'll put up the copy of the presentation and also the recording just after the session onto Moodle, which can be then looked at, for further reading. But in the meanwhile, if you have any questions with regards to learning outcome 1 or 2, you can also email them to me on my email, which is raman@UK Versity. And what we'll do is catch up next week to basically cover the learning outcome 3 of the unit financial accounting and move this forward.
That's brilliant. Thank you very much, Raman.
Okay, take care. Thanks for this. Bye.
Great week. See you next weekend. Have a good week.
You too. Thanks, James.
Bye-bye.